and welcome to this month's edition of the Market Review video. This month, markets focus their attention on inflation and its effect on central bank policies, as well as the COVID-19 evolution in China. More specifically, the US 10-year Treasury yield declined to 3.6% in November from the previous month on expectations that slowing inflation rate would prompt the Fed to slow its rate hikes. We think this exuberance may be excessive, and the Fed is likely to evaluate the inflation trend instead of focusing on a single number. Equities rebounded this month in the United States and in Europe due to better-than-expected earnings and hopes of further deceleration in inflation. Emerging markets also rose, led by Chinese and Hong Kong stocks. While a relaxation of strict zero-COVID policies shaped this optimism, we think the path will remain muddled with uncertainty amid a gradual reopening. Looking ahead, the global economic environment would be characterized by growth inflation dynamics, geopolitics, and corporate earnings in the near term. We expect global growth to slow significantly in 2023 and inflation to decelerate but remain high compared with pre-COVID levels. In addition, there will be huge regional divergences for which investors should watch out. From a geopolitical perspective, the risks from the Russia-Ukraine war remain elevated, as the Poland missile episode showed how quickly things could change. Yet, we see the possibility of a ceasefire in the second half of 2023 as the most likely outcome of the war. In the US, the midterms saw no major surprises and were quickly digested by the market. A divided government should deter aggressive policies at home, while some tensions are arising with Europe after the approval of measures that subsidize American companies. Internationally, we can also expect more on the US-China tension front. In the United Kingdom, the new Prime Minister has changed the fiscal policy stance, with the focus now on tax increases and spending cuts. Speaking about earnings, there is a risk of a profit recession in 2023, with global GDP growth slipping below 3%. Yes, we keep an overall cautious stance, but also look for market opportunities. In this regard, in November, we have made some changes to our allocation. In particular, we have become slightly more positive on the US Treasury. Bonds will stay in limelight, and we believe government bonds such as the US Treasuries now offer better value and diversification potential after this year repricing and amid high risk of economic growth deceleration. In credit, investors should look for high-quality businesses and avoid companies with a tendency to increase debt. Although defaults remain under control for now, we remain watchful given expectations that economic growth will decelerate. Regionally, we favor US over Europe and see selective opportunities in emerging market hard currency debt. In equities, we are now tactically less cautious in the European market, although we continue to prefer the US to the Europe. But we are wary of the US mega-cap stocks. This is time to remain vigilant and explore global divergences. Before becoming more constructive, we would like to see improvements in profit margins or a change in central bank policies. Companies with the potential to improve their ESG profile can also offer opportunities. Overall, we think that investing is about having a medium to long-term view while also assessing the cyclical outlook. That's why we continue to focus on a diversified approach with strong emphasis on asset classes and companies that can withstand the current inflationary pressures. Thank you for your time and wish you all a happy holiday season. See you in 2023.